Hey guys, we're here for our next session. It's going to be on simulating the risk of stablecoins. And we have Marcus, partner at Celo. He currently works on protocol economics and stability. I'll let him take it from here. Can you guys give us a confirmation that you can hear us, hear him specifically? And can you say something?
Yes, thank you very much for this kind introduction. And thanks to everybody online to make time for this talk about stablecoins. So can everybody hear me? Maybe you can use the chat window to confirm that you can hear me. Can everybody hear me? Should I wait another minute to let people transition?
Yes, please wait a few seconds until we get some confirmation.
Sure.
Yeah, so people have been posting in the question and answer section. So also, if you guys just refresh your browsers, the chat window is working again.
Okay, perfect. So I have the first confirmation that people can hear me. So thanks again for your time to listen to this talk about stablecoins. As mentioned, I'm working at Celo and working on Celo. And Celo just launched the first release candidate of the Celo mainnet last week on Earth Day with 56 independent community validators from 19 countries. So very exciting times right now for Celo. At Celo, I'm focusing on protocol economics and stability. I before blockchain, I worked in finance. I also was a researcher in economics. I did my PhD in economics, and therefore I'm talking about stability and stablecoins today. And more specifically today, I want to answer the questions: what are stability risks of different types of stablecoins, and how can they be simulated? I'll toggle my video so that you can see the slides full screen. So first, to start this talk off, I want to give a quick intro to stablecoins, especially since there's no established definition or classification for stablecoins, and they may not actually be stable all the time. They could have risks, and those risks could be similar to several other crypto assets. And therefore, I want to talk about these risks today. But just briefly, stablecoins have many features of traditional crypto assets like Bitcoin and Ethereum, but stablecoins seek to stabilize the price of the coin by linking its value to that of some underlying asset. That underlying asset could be fiat currency like the US dollar, or could be commodity. And stablecoins differ a lot across different projects. They differ according to their exchange rate policy. They differ according to their underlying. They also differ according to their blockchain they are issued on. Also, the nature of claims users have against the stablecoin differs. And therefore, I think it makes sense to talk about simulating the risks of stablecoins. So as I mentioned, the research questions for today are: what are these risks, and how can these risks be simulated? So I already started with a brief introduction about stablecoins. I'll afterwards differentiate then several types of stablecoins and classify them. And then I want to talk about major risk factors and how to simulate them. So let's start first to continue with the introduction. And this introduction in general is, I think it's pretty clear to this audience why there are stablecoins, why the market has demand for stablecoins. Thinking about the functions of money that are being a medium of exchange, being a unit of account, being a store of value. And then looking at the implied volatility of Bitcoin this year, you could imagine that some users in the market have a use case for stablecoins. So what you can see in this chart is the at the money volatility, at the money implied volatility of Bitcoin for different maturities, 1 month, 3 months, and 6 months of just this year. And you can see at some point in time, the volatility spiked quite reasonable. And there were, of course, periods in the past where this was even more severe. And then you could imagine that some merchants who might accept cryptocurrency and want to convert these payments immediately to fiat because they have to account in fiat or have to pay for their goods they need in fiat, that basically the cost base for them is then not really predictable if like the currency is so volatile. Also, maybe traders in Bitcoin or in ETH want to have some stable currency they can move funds into when they, for example, want to move funds across exchanges. And this is basically a clear need for a stable coin that is linked to some underlying. And another view on that, and I think everyone is pretty aware of these price developments, but another view of that would be just looking at the year 2018, looking at different cryptocurrencies and looking into a development of $100 in the beginning of the year 2018 and at the end of the year 2018. Of course, this hopefully or maybe was an exceptional year. However, the history of these currencies is relatively short, and therefore, of course, this can repeat in some other form. And you can see the value in different currencies in that year declined significantly. And you can also see here the value of DAI, one specific stablecoin we also will talk about later. To first give a broader classification and basically differentiate different stablecoins. And please excuse all the text here. I borrowed from the Bank for International Settlements and their classification for different stablecoins. And actually, stablecoins can be very complex ecosystems, and they can differ a lot according to their design. The value of the stablecoin typically is related to an underlying asset. However, for example, the user interface, like the wallets, the exchanges, the resellers interacting with the stablecoin can differ widely. Also, basically, the transfer mechanism can be very different in different stablecoins. So there can be permissionless or permissioned blockchains the stablecoin is running on. So it could be that anyone can be a validator or only selected entities can be a validator. It could be a public or a private blockchain. So it could be that anyone can use the ledger for transactions or only selected entities can use it. It can be public or private. It can be open source or closed source. And then it could also basically be issued by different parties, can be issued by a decentralized protocol, could be issued by a central bank as a central bank digital currency. There's difference also in terms of the governance of these stable coins. What I, however, want to focus on today is basically the stability mechanism of a certain stablecoin and what the risks of different stability mechanisms are. And feel free to ask any questions, and I'm also happy to talk about these questions. So let's go on to talk about the different types of stable coins with regard to their basically stability mechanism. I've classified the stable coins here, and this is basically one way to classify stablecoins in terms of their stability mechanism into 4 different types of stablecoins. You can see these 4 different types here on that slide as 4 different lines. I've classified the stablecoins into fiat or commodity collateralized stablecoins, crypto collateralized stablecoins, seniority share stablecoins, and some hybrid between algorithmic or crypto collateralized and seniority share type of stablecoins. I've also added some examples here. Of course, in the last row, since I'm working on Celo, I added also Celo. I added for the fiat backed stablecoins, USDC and Tether. Of course, there are others. There are also commodity-backed stablecoins that are backed by precious metals, or they are backed by diamonds and gold. So there's like a lot of different things. For crypto collateralized stablecoins, I added as an example MakerDAI. I mentioned that before in the chart. And for seniorage coins or seniorage share stablecoins, I added two examples, one that is still live and one that is not live anymore. One is basically Basis or Basecoin, and one is Terra. And when you look at the differentiation between these different types of stablecoins, you can see the first one, and this is pretty clear by the name, is backed by fiat or commodities with off-chain assets. And for the others, you have on-chain assets backing the stablecoin. And this then already determines basically transparency and governance, because on the first one, with an off-chain collateral, it could be that it's not really transparent. It could be that it requires audits on the collateral. It could also be that this requires audits on the counterparty. And especially governance in this case typically is centralized. With every off-chain backed stablecoin, you want to know where this collateral is basically held and if it's actually in place and what counterparty is custodying this collateral. With a fiat-backed stablecoin, this is typically a bank. And the bank is basically a central entity that stores the collateral. And if the bank is not actually storing the collateral, then it could be a risk to that stablecoin. A bank run could occur, and the bank could basically not have the relevant liquidity to pay back every stablecoin holder. And therefore, there is some risk in liquidity. There's also some risk in demand shocks. It could be that many people want to have this stablecoin, or many people want to sell the stablecoin. So it's basically a negative shock to demand. And then the bank could probably not cater this. And of course, the bank has some counterparty risk. The bank typically has a rating. This rating determines how likely it is that the bank goes bust in different market environments. And therefore, a stablecoin is actually backed by a certain type of credit. And therefore, a stablecoin that is backed by credit should be priced according to basically the counterparty risk, according to the likeliness of the collateral is in place. With all other types, the crypto collateralized, the seniorage share, or the algorithmic or the hybrid type, you have more transparency since the collateral is on chain. And everybody can basically have a look at the blockchain and see if the collateral is in place. And therefore, this also has different types of risks. Of course, with crypto collateral or a seniorage coin as a collateral, you have basically a risk of the stability of that collateral. With other cryptocurrencies, we have seen they are more volatile, and therefore you need some form of over-collateralization. And the biggest risk is, of course, that this collateral depreciates in value significantly, and there's not enough collateral in place. And of course, the demand is a big factor here. Because the demand can be basically jump up, jump down, and there can be a mismatch with supply. Therefore, this can be a risk for these types of stable coins. And we have seen this taking place in the last months as well. So let's talk about these major risk factors. And I mentioned the demand should equal the supply. What you can see here is basically a demand function and a supply curve. And you can see for example, that this demand and supply meets at 20 million in terms of quantity. So there's like 20 million supply of stablecoin in the market, and there's 20 million in terms of demand of stablecoin in the market. And this is the perfect peg case. Because maybe there was no recent expansion in supply of that stablecoin, this quantity is lower. It is only 19 million, but people have a demand for 20 million of stablecoins out there. It could be that the price depegs. It could be that the price depegs into a positive terrain. And then to know how much it depegs, you need to make an assumption about that demand function, about that demand curve, how steep it is, basically. So in this case, there's 1 million of supply too low. The supply is 1 million too low, and then the price depegs maybe to $1 and I don't know 10 cents in this example. However, and this could be probably was a big problem with Basecoin. You have to make an assumption how much you have to expand or contract to see how much you can bring the price back to 1. And the big problem here is that demand is random. So you cannot predict the demand on the next day, in the next week, or even in the next second. This is a random quantity, and it's super tough to forecast it. Therefore, the primary risk of stability for a collateralized stablecoin is basically a scenario in which there's a decrease or even a sudden decrease in demand greater than the total value of reserves. And as I said, it's tough to predict the demand the next day, and therefore it's tough to predict what this decrease is. And then the second risk is basically a scenario where, for example, the value as a collateral or the value of the collateral cannot handle a sudden contraction in demand. So it's maybe not enough market liquidity, or basically the value of the crypto collateral for a crypto collateralized stablecoin decreases a lot. And again, here it's really, really hard to forecast the value of the crypto collateral tomorrow. And therefore, if you don't want to forecast future evolution of markets, or you don't want to perform some form of distribution fitting to historical market data, because you might assume that the history is pretty short and maybe market prices for different currencies in history behave differently than tomorrow, you have to basically ask yourself, do you want to do an empirical or a theoretical study on the risk of a stable coin? And if you do a theoretical study, that is perfectly fine. You have to make assumptions on like how a stable coin reacts to certain demand scenarios, and then you have to probably have to calculate edge cases. However, you could do an empirical study, and you want to use some like data to do that study. And like if you want to use some type of data, you could forecast. As I said, this could be very hard, or you could do a scenario analysis, and then you have to come up with scenarios. To come up with scenarios, you can choose between historical or simulated scenarios, basically. And if you want to simulate scenarios, you have to think about the process, the stochastic process to simulate your scenarios with. If you use a certain process, you also have to think about the distribution you want to assume for assets. You could imagine just using a normal distribution because it's pretty easy, but you could also think about, and I think especially looking at the history of cryptocurrencies, you could infer that cryptocurrency prices have either semi-heavy or heavy-tailed distributions. So it could be that the normal distribution is not the right distribution here. And therefore, you can use different types of stochastic processes to generate scenarios. And when you do that, you could use something like this. It is like a big disagreement what is the best best distribution that best statistically fits prices of individual cryptocurrencies. However, like apart from that, you could use a stochastic process that looks somehow like this. This is a geometric Brownian motion. This is widely used to simulate behavior of different asset classes. I think in finance literature, this is standard for stocks, for commodities, also in option pricing. And to use this process, basically you need a formula that looks a bit like this down below. This geometric Brownian motion has basically this first part of the equation, which shows you that the multivariate geometric Brownian motion to simulate different crypto asset classes, maybe even with some form of correlation, since typically crypto assets are highly correlated, needs an assumption about these correlations. It also needs an assumption about the mu, basically the expected value in the future, and also about the sigma squared, or the volatility of that crypto asset in the future. However, if you just use this, it could be that this results into normally distributed returns. And as we said, cryptocurrencies could have non-normal returns. Basically, they could have jumps. And therefore, you can introduce those terms here. Basically, you could introduce idiosyncratic jumps for individual assets. Let's say the demand or the price of one asset jumps by a certain amount on a given day. And it could also be that you want to introduce market-wide jumps. Basically, all crypto assets jump on a certain day. Just seeing that there are already some questions. Have you investigated Levy distributions for your sampling distribution? Yes, we have looked at many different distributions, looked at the Levy distribution. Also for the jumps, we looked at Poisson distributions. So like for simulating stablecoins, you can and should look at different types of distributions, maybe even trying not to make any assumptions on the parameters. To continue with this one, so basically the geometric Brownian motion, including jumps, is one way how you could simulate market prices for your crypto asset classes. And then when you look at your simulated market prices, and here you can see a daily simulation of 30 years of either demand for stablecoins or returns for other crypto assets, you can see here that this is heavily depending, of course, on the parameter settings. However, and you can see here a geometric Brownian motion with a mu of 0 and a sigma of 0.75. You see on the top a few paths that go up, and they maybe even go up to infinity. And then for the geometric Brownian motion, to keep that expected value of a mu of 0, the important thing is that like many paths have to go down to, on average, yield an expected return of 0. And this shows you a standard problem of the geometric Brownian motion. There's no basically return to the mean parameter, basically. What you can see here is even with a drift of 0, you can see that a significant downward evolution of a large proportion of these paths. So the thick, colorful lines show you the proportion of paths that are below the line. And you can see basically at this red line that 75% of the paths are below it and are decreasing. And then the same you can see with a geometric Brownian motion with a mu of 0.5. Big problem here is what you can see is at some point in time, all of these paths go to infinity. So in the end, if you do a simulation using a positive mu, at some point in time, everything goes to infinity. So you have a pretty optimistic view on your demand or on your cryptocurrency. And what we are now using also in the stability analysis we did on Celo is a geometric Ornstein-Uhlenbeck process the formula of this geometric Ornstein-Uhlenbeck process looks a bit more complicated. Basically, the formula also introduces a mean reversion speed and a drift parameter. And this drift parameter is similar to the expected value. However, it has a mean reversion speed. And if you introduce this, you can see more well-behaved paths. What you also can do, and I see that I'm running out of time already. What you also can do is you can introduce these jumps I talked about for the geometric Brownian motion. You can also introduce them for the Ornstein-Uhlenbeck process. And what you can see here is basically with the solid lines is the percentiles for the geometric Ornstein-Uhlenbeck process. Including jumps. And here in this case, since we had a question around the distributions, here with jumps determined by a Poisson process with jump sizes that are log normal distributed random variables. As a reference point, you can see also the solid lines. They depict the percentiles of the Ornstein-Uhlenbeck process basically without jumps. So you can see you have like a much broader set of scenarios here. So only 3 minutes left. Just like a quick recap, what we talked about is basically when you look at different risks, you can use stochastic processes to simulate these risk factors. These risk factors can be, for example, demand. Jumps in demand can also be jumps in the crypto market that is backing up the cryptocurrency. I think performing a scenario analysis using empirical, basically simulated paths can help to get a more or a better view on the risk or the risk factors of your stablecoins. So let me quickly look into the question. One question is, why did Celo choose a hybrid stablecoin type? So basically, as I mentioned, it is with a pure senior share stablecoin. It's relatively difficult to determine the expansion or contraction amount, since you have to make an assumption about the demand function. And therefore, we have on Celo, we have chosen for an basically market-based expansion and contraction mechanism that looks a bit similar like a Uniswap exchange, where basically market participants can expand or contract. However, for expansion and contraction, we don't only want to have a seniorage coin, since in the beginning, especially of the protocol, this doesn't need to have some value, and therefore there is additionally a reserve that also backs this mechanism. And then
I think we're almost done. If you want to give them a heads up on where they can learn more about Celo and the stability mechanism, that'd be great. And then I'll port them over.
Sure. Yeah, the best entry point is the Celo webpage. If you have a look at celo.org, you find the white paper. You can also find the stability analysis next to the white paper. This is this empirical study I mentioned. Feel free to always ask us anything around this. You can see here on the bottom right my email address, the chat, and also the Twitter of Celo. You can get information there. You can ask questions there. We're always happy to answer any question. And sorry that I left so few times for it now.
There is. It was a really informative talk. All right, so we're going to transition to our next session now. Thank you so much. It was great.
Cool. Thank you.